what's going on, everybody? Welcome back. Back with another market update. Get our October market update in. There's a lot going on. Great up month going on so far, which is awesome to see. Getting a little bit of a rally right here, which I think that this might continue to happen, at least during the short term with the midterm elections coming up. Might see a little bit of gridlock happening up there in Washington, which is always great for the markets. So could see a little bit of a rebound there. Potentially, maybe the Fed's going to come out and say they're not going to have to raise interest rates quite as much after the December meeting. We're kind of hoping that could happen. So there could be a little bit of some tailwinds going forward. I know we haven't talked about that in quite a while. We've only been talking about all the bad things that are coming down the pipeline, but potentially could see a little bit of a short-term boost. Now, a lot of people are still calling for a recession towards the end of 2023. So by no means are we just out free and clear, past the inflation issues, past all these issues that we've been talking about. But hey, we all like to see some short-term rebounds, right? And it's happening quickly right now, which, part of what we've talked about. We can't be panicking during the down markets. The biggest days tend to come after the worst times. I mean, these rebounds, a lot of times they happen quickly, and we're seeing that. I saw a Market Watch article this morning that said this could be the best October that Dow Jones has had since like 1940 or something. I mean, it's absolutely crazy, the rebound that we've been having, especially within the Dow. But things are still down on the year. So we want to kind of look back and see where things are at. So year to date here, we got all these lines up. We'll kind of go through them really quick. The Dow Jones here still down almost 10% year to date, even with this great month that we're having, still in bear market territory, just about there. The ag here, this is the bond index, so down about 15%. And this is what's kind of weird about this year. I'm also going to look back and see, is 2022 worse than 2008? But, a lot of times we talk about the bond side of the portfolios and the fixed income side being that buoy that kind of lifts things up when the equity market's going down. I talked to, especially if you're a client, we've talked a lot about this. Even the riskiest clients, we have that counterbalance. The riskiest clients, of course, we have a lot of equity exposure, but we still want to have a little bit of bond and fixed income exposure to counterbalance that out. Because normally, when the equity markets are performing poorly, bonds help support that. And same with a very, very conservative client. Conservative clients might think, hey, we should be in 100% bonds. Well, that's not quite true. If the bond market is performing poorly, we want to still have a little bit of equity exposure, again, as that counterbalance to be well diversified, which we talk a lot about. But weirdly, this year, the bonds are down a lot as interest rates continue to rise. So the bond index here, and again, this is just one, but it down 15%, which is crazy to see. And that's why portfolios are getting hit so hard. Again, what normally works as a counterbalance and as a buoy is getting beat up as well. So portfolios are just suffering right now. Moving on here, the S&P is down about 18% year to date here. This is the foreign index, so markets, outside of the U.S., obviously, so down a little over 22%. NASDAQ, we've talked about a lot, the tech-heavy index, they get hit the hardest with these inflation concerns. And with rising interest rates and things, corporate profits are probably going to be going down, and the NASDAQ tech companies get hit hard. So NASDAQ still down almost 30% year to date. And this is kind of the crazy one. If you've been watching the market the last couple of days, this has been pretty big news. But year to date, Amazon down almost 40%. They've gotten just absolutely crushed. And even crazier Meta platforms, formerly known as Facebook, down 70% year to date. And it kind of just goes back to the diversification thing. If you're holding a large position in Meta platforms or a large position in Amazon, it's easy to think, hey, Amazon's so big, that's nothing bad's ever going to happen to them. Facebook, Mark Zuckerberg's at the forefront of everything. We're headed into the metaverse and all these great things that they're doing. All of a sudden, it just gets smoked. So, I'm not a huge person in especially short-term trading, but also into individual stocks. For more risky clients, you may be one of these. We can have 10 to 15% of the portfolio in different individual stocks, but not a large position in any single stock, just because of this fact. Who would have thought that Meta Platforms was going to drop 70% year to date? That can absolutely just crush a portfolio. So the interesting thing is we can make this chart look a lot happier if we just look at the last month here. Things have been, like I said, October's been a good month so far. Spooky season has not been so spooky for the markets. Dow's up about 12% just this month. The foreign markets up 7.5%. S&P's up about 7%. NASDAQ lagging a little bit, up a little over 2%. Bonds are still kind of flat, nothing crazy, but at least not losing like they have been. And then, again, of course, here, Amazon and Meta have just gotten absolutely beat up over this last month. So, again, it's unfortunately, it's not that uncommon right now for a portfolio to be somewhere around this, 18 to 20% down, just due to the fact that everything's been beat up. There's not really been a super safe place to hide besides, the fixed index annuity space, which we've talked a little bit about, having some more fixed products in there where you have a little bit more of a zero floor. That sort of stuff also helps as a little bit of a buoy, but more of our quote unquote normal investment structures, everything's been kind of taking a beating. So being down somewhere, I guess, somewhere between this 15 to 20% range, depending on the risk tolerance, is pretty normal right now. Anything above that, if you're down 25, 30, 40% year to date, I probably would highly suggest looking at rebalancing and seeing, you might be overweighted in some individual stock positions that have taken a big hit, like Meta. That's how that can begin to happen. But again, diversified portfolio, a lot of portfolios right now, you're going to be seeing somewhere 15 to 20% range down, again, depending on the risk tolerance. So kind of comparing and looking back to 2008, because a lot of people are having this conversation like, man, we haven't had this sort of a year since 2008. It might even be worse. So what actually did happen in 2008 versus now? Basically, looking at a couple key indicators here. So looking at inflation, just with the consumer price index, in 2008, the CPI was at negative 0.2. So inflation was basically flat. It was irrelevant. In 2022, inflation is up 8.3%. So a huge issue. And of course, I know this is no news to you. We talk about this all the time in any news outlet that you go on. It's inflation, inflation, inflation. So it's up over 8% higher than it was in 2008. So obviously 2022, it's worse on that front. Looking at the equity markets, in 2008, they were down about 37%. Again, right now we're down, looking at the different indexes, about 20%. So we're doing better by about 17%. So 2008, equity markets in general were down a lot more. It was worse back then. Looking at the bond markets, this is pretty interesting. So in 2008, the bond markets were down about 4%. So far in 2022, they're down 12%. So again, this is what's pretty crazy. That spread is a lot narrower right now because bonds are losing at a rate that's almost as quickly as the equity markets, which just not ever happen. It's a very weird time frame. So again, not a lot of safe places to hide right now. We're actually sitting a pretty high position in short-term bonds right now. We're getting about a 4% yield on those, which has been a pretty safe spot, at least now going forward. Looking at potentially turning those into some intermediate bond plays. We can probably get some higher yields around the 7 to 8% range right now with where the 10-year treasury is and everything. So looking to move from short duration to potentially intermediate duration on the bond portfolios, at least within our portfolios, is kind of where we're heading. But again, 2022, it's much worse. Bond markets are down around 12%, while in 2008, they were down 4%. So 2022 is much worse so far in that category. Real estate, 2008 was down about 43%. Currently in 2022, we're down 22%. So about half. The real estate market got hit a lot more, obviously, in 2008 than it is currently. Gold, this is another interesting one. Everybody thinks of gold as kind of a safe haven, another good spot to hide when the market's doing poorly. Gold should perform well, right? Well, in 2008, it did. Gold was up 3%. Currently this year, gold is down 9%. So again, all these potential, safe havens that we're used to having that did actually perform as safe havens more so in 2008, they're not acting that way currently. We're in a very, very weird market cycle where everything's down, which is kind of crazy. And to think about, what sectors are going to boom back the highest. We talk about this a lot in our weekly investment committee meeting. Where should we be structured so that we can really catch this upward rally? That's going to happen, right? We're not going to stay at these low prices forever. And again, we're seeing some of it this month. Personally, I kind of think that we're going to see just a market-wide rally. Of course, I think tech is going to boom up quicker than most of the other ones just because they've been beat so hard. But everything is down so much that any sort of momentum, I think most sectors are going to rise together on just a market-wide rally. Again, this hasn't happened in history before where bonds are down as much as they are, gold is down as much as it is. I mean, everything has just been so beat up that any positive news, I think we're going to just get a very, broad sector rally. So kind of just moving forward here, again, talking about the single stocks, how volatile they are. And actually, I just got back from Orlando a couple weeks ago. We had our annual education conference up there. It was awesome. Stayed at the Swan and Disney Dolphin Resort. They actually rented out Star Wars Land for an evening. We got to go on all the rides. There was nobody in the park except advisors. It was really fun. If you haven't been to Star Wars Land in Disney World, it is awesome. I'm not even that huge of a Star Wars fan, but it was just an incredible experience. So I learned a lot up there, a lot of best practices, what other advisors are doing, just a lot of great information that's shared between, advisors all over the country. So one thing that I really took away from the conference and something that I'm implementing more into my portfolios, especially with my clients, and if this is something you may have heard of before, but it's called Riskalyze. And it's a great way to kind of, measure the emotional aspect of what's going on, because we talk about risk all the time. And if you're a personal client of mine, we've had this conversation, how risky do you want to be? How much money are you willing to lose? But it's so intangible and just kind of out in the air that it's hard to really bite your teeth into. So then when it actually happens, it's hard to be prepared for it. As much as we can talk about it, it's different when you actually look at your statement and you see I'm 18% down year to date than if we're just talking about it. So Riskalyze, I want to just show this to you really quick. It's really, really brief. I'm more than happy to run through this, with you if we haven't already. But basically, we can just, and I've already answered the questions. You go through a whole questionnaire, and it helps to have that emotional aspect of, hey, this is what can potentially happen with the type of portfolio that we're going to use. How much are you willing to risk to get a certain reward? For this typical portfolio, if we can look for a 8.7% return, you have a chance of gaining $26,000 and potentially losing 17. So it actually kind of helps to say, yeah, I am comfortable if I see my statement, I'm down $17,000 on a $100,000 investment. I'm okay with that, or I'm not. And we need to scale that back a little bit. Where is your real comfort level? And it ends up here. It gives you a risk level. It's got like a speedometer of your appetite for risk, and then we can kind of base the portfolios off of that. Which again, if you're a personal client, I'm already doing this. We have these conversations. I just didn't have this interactive tool where we can actually say, hey, with this type of model, this is the potential upside and this is the potential downside. Are you comfortable with that? So I kind of, again, I'm going to be implementing this with you if we haven't already. If you'd like to take a look at this and go through it together, I'm more than happy to do that. It just really, again, helps you to sink your teeth into actually what could be happening, because unfortunately that red number right now is what we're experiencing in real life. And it just helps if we, set that preface up before. So back to the actual market here. Last thing that I wanted to talk about was basically 4 ways to handle a down market. And we've been talking about how to handle a down market a lot. And the market's actually up this month, but still, we're still down a lot more than we have been in the last 10 years. So kind of just 4 different thoughts on this. Number one, bear markets and down markets, it's not an if, it's a when. We're not day traders here. We're not short-term investors. Being in the market long-term, there's going to be bad times. So if we can have that in the back of our mind, I think it helps to emotionally just take it, and realistically, I kind of like to compare it. It's like a haunted house for me. If you know me, I hate haunted houses, hate haunted houses. Right now, it's haunted house time and my girlfriend wants me to go to a haunted house with her, and I don't want to go. But it's kind of funny, even though I know what to expect when we get there. I know for sure that there's somebody hiding around the next door with a chainsaw that's going to jump out at me. I can tell you it's there, and it still scares me every single time. You know exactly what's coming. I could see the guy's shadow standing in the corner that I know they're going to jump out at me. Still scares me, right? I can't get past that. But with the market, if we know that these things are coming, of course there's nobody that just rings a bell and says, hey, bear market's going to be here in 5 months. But as a long-term investor, we're going to see these things. We've seen them time and time again. They've happened throughout history. There are market cycles that happen in a bear market. A down market, unfortunately, is part of the market cycle. So they're going to come. There's no long-term investor that's going to escape every single down market. It's part of the market cycle. So just to kind of keep that in the back of your mind in that aspect, I think it can help emotionally. Number two is being diversified. Again, we do not want to have a large portion of stock in meta platforms right now. Or ever. I constantly am looking at clients' portfolios and talking about being better diversified. Maybe they have a lot of position in their own company stock, things like that. Being diversified really helps these down markets because, right now, maybe you're down 18, 20%. We're not down 70. Being down 70% this year really, really hurts. So being well diversified with some different fixed income products, potentially some different fixed products, and then just different sectors within the equity market, we're not going to feel the brunt of this downward pressure as you would if you're overly exposed to certain individual stock plays. The third way that we can help to handle a down market is having a long-term game plan and sticking to it. It's kind of the same, with this being diversified. It's the whole point of creating a financial plan, using Riskalyze, using all of these tools. Then we have already forecasted. We know that you're going to be able to reach your goals in this time frame. Down markets are built into our plan. We're not expecting the market to go up in a linear fashion every single day, every single week, every single year. We know that these times are coming. So if we have that long-term game plan, you know what your financial plan is, you know when you're going to be reaching your goals, how you're going to be hitting them, all of these things that we talk about, then these down markets don't affect us as much. We just continue moving forward with the plan and just continuing to invest. Another thing that I think is pretty funny is, right now, just the psychological aspect of a down market, right? The stock market is the only place that for some reason, consumers don't want to buy when it's on sale. Everybody wants to buy when things are rising, and when things fall, they want to sell. And every investor knows, buy low, sell high. I mean, come on, it's common sense. But when it comes to the actual clicking of the button, that's not the way that we work. So I think it'd be a great behavioral economics test to have all of the news stations, instead of saying the stock market's down, inflation is killing us, market down, 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 down. If they were to say the market's on sale, what would happen? Everybody goes, and I think it's like it's about to be snowboard season up here in Northern California. Nobody in the right mind goes to the ski slope without anything, and they go to the store right next to the gondola and buy their jackets, pants, boots, snowboard, everything in prime season right next to the gondola. It's the highest prices. You're going to go find some spot that's far away from the hill in the middle of summer, preferably in the middle of nowhere, that's going to be selling the same stuff for half the price in the off season. Well, right now is the off season for the market. It's the same thing. We're buying all of the same things. We're buying the same funds at a discount. But for some reason, the stock market is the only place that investors don't like to buy at a discount. They want to buy at a premium. So again, just something to keep in the back of the mind. Last way, the fourth way to handle a down market is don't refresh your phone every 30 seconds. It's just going to drive you crazy. If you've been on cloud 9 this last month because your portfolio is going up and up and up, that's almost as bad as if you've been depressed for the last 9 months because you're refreshing the phone every single day looking at what your account balance is. It goes back to having that long-term game plan and sticking to it. We're not day traders. We're not trying to take advantage of, movements that are happening every single second. We have a long-term diversified game plan, and we've built the financial plan around that. So there's no reason to refresh the phone every 2 seconds because that's not how we're going to win in this game. So that's everything that I got for you guys today. The October market update. We'll come back in November and hopefully things continue on the same trend, but hope everything's going well over there. If you have any questions at all, I'm always more than happy to chat. Send me an email. You can go to hunterlowry.com, schedule a call with me. We can go through Riskalyze, go over your financial plan, whatever it is that you need. Always more than happy to chat. So feel free to hit me up at any time, and we'll see you guys next month. All right. Take care, everybody.